Good morning. We are back in Atlanta. It is Thursday, January 12th, 2023. We did make it back yesterday after the airline fracas. It was only a 2-hour delay in the end, so we were back in the office at 2 p.m. But thankfully, we did make it back to the office because we have a lot of news out this morning. The biggest piece of news, of course, is going to be the CPI report. That CPI report is coming out as we speak. I would make one quick programming note on the CPI number is that beginning with this data, the Bureau of Labor Statistics plans to update weights annually for the Consumer Price Index based on a single calendar year of data using consumer expenditure data from 2021. So there are going to be different weights within the CPI. So this is not exactly an apples to apples comparison. So with that as context, Tom, do we have the number?
Yep. So the expectation today, the surveyed amount was 6.5%, coming down from 7.1%, and we came in exactly in line. So inflation as of today is 6.5%. The month over month was actually a retraction of 0.1%, and then core ex food and energy came in at 5.7, down from 6. So is it safe to say here, January 12th, 2023, inflation is officially dead, Ben? Or are we, you think we maybe hover around this area for a while? You think 6% might be maybe a sort of a temporary floor?
Well, this is a very impressive number. I think that it certainly speaks to the declines that we've seen. It looks like apparel inflation actually picked up in the month of December. It seems that there were fewer markdowns. Shelter inflation was actually accelerated, and that's expected to go down. And so if you look through this, some of the things that were actually allowing inflation to be high continued to be high and even accelerated this last month, but those are expected to go away. If you look at the shelter price inflation up 0.8%, 7.5% year over year, that operates on a lag, and that'll be expected to come down. So overall, I think that this is a very good number. I think that the market will probably be a little bit flat on this. At least that's how it trades. The market may actually even go down because a lot of people expected this, but I think that inflation is coming down, and it's coming down now at a fairly aggressive rate. 0.3 on the core, 0.6 on the headline, and you're actually in a deflationary environment on the month over month on the headline. Of course, that includes energy and food, but it's good. It's very good news. And it echoes a lot of what we heard over the last 3 days at the ICR conference in Orlando.
Yeah, I think it's some of the main takeaways, and I guess kind of throughout this week, we'll probably get into what we saw, but I thought it was very interesting that given how bad everyone saw 2022, how cautiously optimistic all of the CEOs we saw were. Almost all of them said, hey, we've got opportunities here. Inflation has hit us, but not as hard as we thought. We've been able to push price for the most part. We don't want to keep doing it, but we think that we're maybe ahead of schedule and we can maybe ride that through the second half of the year and hope that inflation comes down. And we're starting to see that happen. So I think there is some cause for optimism for 2023 in the markets. I think there's definitely cause for optimism in bonds. We've been able to, recycle through a lot of bonds this year and replace them with ones yielding quite high. And I think those are going to continue to stay there. We still, we just got a quick update here on the expectations for rate hikes, and they're pretty much unchanged. Right now, we're looking probably one rate hike on the 1st of February, and then potentially one more on the 22nd of March. And that's probably, at least for the time being, where we'll end up in terms of rates, which will put us right at 5%. I had a ton of Fed representatives out this week saying 5.25, 5.5 might be where the stopping point. And, given that the Fed has seen that their strategies worked, which is they're going to ramp rates up, maybe not all the way to where inflation was, and hope that inflation meets in the middle. Given that we're seeing that, given that they all kind of are in that 5.25, 5.5 range, I think that's probably where we end up. I think they're probably going to say, hey, we were right. We continue to be right. We're going to stay on this path. So, somewhere between 2 and 4 rate hikes this year, which is very palatable at these levels, especially given the moves we saw last year, and inflation is coming down. And it's possible that we could see a stop and a pause on the rate hikes and kind of level off there, I think.
I mean, if you look at the month over month inflation numbers, you went from 0.2% in November to 0.3% in December. And that includes an acceleration in shelter, which again is not happening. So I would say that the core inflation right now, if you look at it, is probably closer to 3%. And if you want in the headline inflation to come down, the Fed keeps talking about they need a rate higher than inflation. I mean, that means you got to have a rate above 3%, which would mean that the Fed is actually in restrictionary territory right now. And the current level of the Fed funds rate is arguably appropriate. Now, all of this stuff we knew kind of coming into the day. This is where the market was. This is why the market had rallied the last couple of days. And so I wouldn't be surprised. And I think we are, and Tom, you may be able to confirm this. I think we're seeing a little bit of a pullback now in the market, erasing some earlier gains. And that would be as expected ahead of a big earnings day tomorrow. But overall, I would say we are potentially in a little bit of a Goldilocks period. There are a lot of parallels as we look back, and we'll talk about this on Tuesday at our macro presentation. So a quick programming note there. But there are a lot of parallels with 2018. I think that 2022 had. You had earnings grow significantly, and you had the market fall dramatically. And the reason the market fell was because valuations fell. Why did valuations fall? Well, number one was the Fed was getting aggressive at tightening monetary policy, and there were concerns of a recession. And I think you're seeing a lot of the same things right now. And what happened in 2019 was the market rallied 33% in the face of really de minimis earnings growth, and as the market played catch up to what the fundamentals were doing. And so I don't think that anyone's looking at a 33% gain in 2023, excuse me, as the base case. But I would say that the collapse that we saw in markets in 2022 was primarily the result of valuation compression as a direct result of monetary policy tightness at the Federal Reserve.
Yeah, so we're seeing, I mean, as far as I can tell, we haven't changed a ton in terms of equity markets. We're kind of in that up 30 basis point range. Not a lot of movement there just yet, but typically that arrives on a little bit of a lag after information like this. The bond market, on the other hand, is on fire. 10-year treasury is all the way down to a 349. At first, we saw a little bit of what I would call an anti-inversion move. The front end turned green very quickly, and the back end started to turn red, and now everything is green all the way across the board from 1 month treasuries all the way out to the 30-year treasury. We're seeing extremely strong buying with a real emphasis on 10 years and out. I mean, I think it's going to be a pretty nice day. I think people are, despite the expectations being kind of in line, I think that we're going to see some positivity. I think people were just ready for a good number. So we'll see if that holds up on equity markets. Bond market's going to look really nice today.
There is a 30-year bond auction today that we'll have to keep an eye on too.
Well, after this move, I would expect it to be pretty soft because I mean, we're seeing big buying. So we'll see how that turns out.
KB Home provided an update on the state of the U.S. housing market last night, and it was not good. So transitioning from inflation and potentially where we might be going in terms of Fed policy to what companies are having to deal with right now, because those are two different things. The Fed is making policy, and that will affect stock market valuations, but companies are still having to deal with inflation. They're still having to deal with uncertain demand. And that's just a reality, and it'll continue to be the reality in the near term. So juxtapose those two against one another right now. But KB Home missed on revenue expectations. They came in at the lower end of guidance. Average selling prices up 13% year over year, which sounds like a lot, but that was a deceleration from 21% in Q3. The cancellation rate, this is something that really stood out to me. The cancellation rate was 68%. Home cancellations. That's up from 35% last quarter. And we were talking about inflation coming down in goods prices and other prices and in shelter prices as well. Well, get a look at this. They said in the fourth quarter, we prioritized delivering our large backlog and protecting our high margins over taking steps to stimulate additional sales, essentially saying we held price in Q4. and we ate it on cancellations and we ate it on volume. But we are getting more aggressive with our pricing ahead of the spring selling season in order to generate new orders, aka prices are going to start falling on new homes. They said that they're looking at pursuing reductions in direct construction costs and build times. So there's an impetus right now from inflation and pricing and increasing in pricing to prices going down and costs going down and managing the costs. And right now, buyers are increasingly in a more powerful position than sellers. And KB Home is looking to leverage that and navigate that channel, because they obviously have a buyer in the home buyer, but they also have sellers that they're dealing with in terms of their suppliers. And so they're looking to, in parallel, take both of those prices down.
Yeah, I think that's I think that's just the trend we're seeing. I think we're really seeing the inflation bubble pop just across the board. And I think that,
and it's popping rapidly.
Yeah. There's been a lot of joking about the Feds, like, oh, inflation is going to be 2% next year. They said that in 2021, we saw it just ramp up, basically double in the course of 6 months. But now that we're seeing it leave the market, it's leaving, and it's leaving in a big way. So this is, I think it's one of the more positive days we've had. And I think housing affordability is just going to lubricate the economy even more, right? Prices come down in tandem with interest rates coming down on mortgages, then we could see a real strong acceleration in the housing market, which of course is going to push the economy in the right direction.
And I think when you say reacceleration, I think acceleration in home formation, home building volume, not prices.
Yeah. You'll see more home sales at a lower price, at a lower interest rate, and all of that begets more buying.
And the mortgage rates falling again today, probably.
Yeah. They're going to reset bigly tomorrow.
Disney is making moves. Makr Parker, the former Nike CEO, he's moving to chairman of the company. That is not enough for an activist investor by the name of Nelson Peltz, who runs a fund called Trian Group. He laments the poor corporate governance, the poor capital management, especially the acquisition of Fox, all the money spent on CapEx, and says basically that they have subsidized a very poorly managed streaming business with parks that over earn. He says that they've pushed prices way too much on the parks and that they have not raised wages in concert with that. And as a result, it's not a sustainable business model for Disney. And so he advocates that they need to have significantly better cost discipline on the streaming side and just kind of these other expenses and rebalance the business. And I hear a lot of his concerns. Right now, Disney's saying that we understand what's going on. We'll have conversations with our shareholders, but we don't want you on the board. But I think Peltz brings up some really good points. Tom and I were just down in Orlando, and Disney has some phenomenal assets. They have a lot of great assets. They have a lot of great intellectual property. They have great parks. They have great products that they can sell at attractive prices, but it's packaged in a way on the business side that isn't necessarily in the best interest of their customers. And I think it needs a really good leader who can transcend domains, whether it's from the parks to the streaming, to the film production, to the creation of content. Transcend each of those domains with a singular vision. They need a one Disney plan. You know how they had one Ford back with Alan Mulally? They need a one Disney, and they need to bring it all. How does this picture all look together? I think that's what they need to do. Iger might make the first steps toward that, but they need a good CEO. And to do that, you need good corporate governance and a board that's going to pick the right one.
I am not a Disney person. I'm not into Star Wars. I'm not into Marvel movies. I'm not into Mickey Mouse. But it absolutely blows my mind the number of people who are in Orlando in the middle of the week on a weekday night. Tens of thousands of people walking around Disney Springs trying to give Disney their money. So they have an effective strategy in the sense that they managed to put a worm in people's brain that makes them buy anything Disney. The question is, how come they can't monetize that and use that to to improve their stock price. So if they can get these things aligned, I think it's gonna be great. But I mean, that Disney store went in there. I went in there looking for something small for Molly, and I've never been a place I've wanted to be in less than that Disney store in Disney Springs. I mean, it was chaotic. It was gross. There were a bunch of weird people in there. And they just had a mishmash of garbage. I mean, like, Disney character Guess Who and a bunch of tchotchkes and, like dolls from movies that no one's watched in 25 years. But also like, there was only like 5 or 6 movies even represented, I feel like. So I don't know, it was weird. I don't understand how Disney works. I don't understand why people are so excited about Disney, but they should be able to turn that into money, but they don't seem to be able to do it.
How much money did you spend there?
I only spent like $25. I mean, granted, earmuffs. I did get something for Natalie's child as well, because she loves Disney in the exact opposite way that I do. So, it's I just don't know how they can't make money. It drives me nuts, because I mean, they have people by the brain in a way that very few companies do. I mean, they're just hypnotized by it.
Taiwan Semiconductor reported earnings last night. They are basically a manufacturing company for Apple, Nvidia, a lot of other companies. They're seeing a lot more demand on the hyperscaler companies. Think Meta, Apple, Google, Microsoft, who are actually using Taiwan Semi to fabricate their own high performance computing chip designs. So they're seeing some growth there. The smartphone business is weak, and there's this inventory reduction going on in the chip land. So guidance for Q1 was quite weak. Guidance for the first half of this year was soft. But importantly, they said that we are starting to observe some initial signs of demand stabilization, and we will watch closely for more signs. They expect to see a healthy recovery in the second half of this year. Overall, I think this bodes for a difficult first half for the semiconductor companies, but I would also caution it and say Micron made a meaningful low on September 26th, and then they lowered guidance dramatically in December, and yet the stock did not make a new low. In fact, it went up, and now it's up 20% since that time. What the markets are saying is the semiconductors have bottomed, and that we're at the beginning of the end of this down cycle. We're at the beginning of the end of the inflation. We're at the beginning of the end of the semiconductor down cycle. And I think that that's something that we need to consider as we approach 2023. So we'll have a lot more to say on this next week at our macro presentation on Tuesday. So we'll hope to see you there. But we'll be here tomorrow morning to discuss all this a little bit more, as well as a bunch of earnings reports from the banks in the early morning tomorrow. So we'll see you then.